In a world of economic unpredictability, with inflation, volatile markets, and looming recessions, the dream of early retirement is not only alive, it's thriving. According to a 2023 NerdWallet survey, a significant portion of Americans are looking to break free from the 9-to-5 grind well before hitting 60. But how are they navigating these turbulent financial waters to achieve their early retirement aspirations? Today, we'll be talking about the FIRE movement and how the skills they implement could help you retire early too. Before we begin, if you'd like to join a stellar investing community, sign up for a premium membership in the link in the description below. Unlock the secrets to formidable investment gains with a premium investing membership. Dive deep into potential multi-baggers, stocks primed to soar by hundreds or even thousands of percent over time. With real-time updates on a genuine money diversified portfolio, exclusive market insights, educational content, and a weekly newsletter packed with actionable strategies, it's time you elevated your investment game. Don't miss out. Join the inner circle of informed investors now. Stay tuned until the end of the video where I'll go over the different types of FIRE. What is FIRE? The lifestyle movement known as Financial Independence Retire Early, FIRE, emphasizes rigorous saving and investing, enabling individuals to retire earlier than conventional means might permit. Its objective is to reach a state of financial autonomy, allowing people to decide how they allocate their time. Rachel Burns, a certified financial planner from True Worth Financial Planning located in Folsom, California, describes it as essentially achieving the monetary freedom that grants one the highest degree of life flexibility. The acronym FIRE originates from a 1992 publication titled Your Money or Your Life, authored by Joe Dominguez and Vicki Robin. This work delves into transforming one's perspective on finances to attain fiscal self-reliance and to lead a life resonating with personal aspirations and principles. Even with the current challenges of inflation, fluctuating markets, looming recession concerns, and climbing interest rates, many still aspire to retire early. A 2023 survey by NerdWallet disclosed that among Americans intending to retire but haven't yet, 25% wish to retire prior to reaching 50, and 18% aim to retire during their 50s. The mean age pinpointed was 57, a decade before the age set for full Social Security benefits. The allure of early retirement persists as economic disturbances, although troubling, are fairly typical. Such uncertainties should be integrated into financial planning, as stated by Burns in a correspondence. Burns further elucidated, FIRE stands as a long-haul approach, and short-lived economic incidents shouldn't induce hasty reactions. While there might be times necessitating tweaks in expenditure or savings in response to market shifts, the foundational approach should remain consistent. Individuals who embrace the FIRE strategy for early retirement often make significant financial adjustments. They do this by dramatically lowering their expenditures, seeking avenues to boost their earnings, and diligently channeling their savings into both tax-advantaged and regular brokerage accounts. However, pursuing the FIRE pathway isn't without its sacrifices. To increase their investment pool, many adherents strip down their spending to the absolute essentials. As alluded to earlier, it's not uncommon for those following FIRE to allocate 50% or even more of their earnings towards savings. Yet, as Burns points out, such a lifestyle isn't feasible for everyone. Some, especially those with families, may find the demands of a frugal FIRE lifestyle too challenging to maintain. The rule of 25 and 4% rule. Followers of the FIRE movement frequently adhere to two primary financial guidelines: the 25X rule and the 4% rule. The 25X rule, often referred to as the rule of 25, posits that one should amass savings equivalent to 25 times their annual expenses before retiring. To determine this amount, one would multiply their monthly costs by 12 to arrive at an annual expense. This figure is then multiplied by 25 to establish the target FIRE number, which is the sum needed to retire. For instance, should someone spend $6,000 monthly, their annual expenditure would be $72,000. When multiplied by 25, their FIRE target becomes $1.8 million. For those who find this number daunting, there's always the option to seek additional income sources and then channel those added funds into investments. The 4% rule is a guiding principle suggesting that retirees can safely withdraw 4% from their savings during the first year of retirement and subsequently adjust for inflation in the ensuing years without depleting their nest egg. This rule is predicated on a 30-year retirement duration. Therefore, those intending to retire earlier might find it less applicable. Burns emphasizes the importance of prudence when navigating such guidelines. She observes that many advocate for specific monetary benchmarks or even suggest withdrawal rates like 4.5%. However, she cautions that these widely touted standards are just that, generalizations. As Burns astutely points out, financial recommendations are seldom universal, and one-size-fits-all advice rarely holds true for everyone. The right savings rate. Determining the correct savings rate is pivotal for those aspiring to retire early. It necessitates careful consideration of the yearly amount one intends to set aside and invest to realize their retirement objectives. Paris Woods, a New Orleans-based author of The Black Girl's Guide to Financial Freedom and a proponent of the FIRE movement, advises individuals to tailor their savings rate in line with their desired pace to financial freedom. For those ambitious enough to seek financial independence within a decade, Woods recommends an aggressive savings approach, allocating approximately 70% of their income toward this goal. The magic of compound growth. The power of compound growth cannot be understated, especially in a world contending with inflation. Merely stashing cash in a bank account might fall short in maintaining one's financial stability over a span of 4 decades. A more strategic approach involves channeling funds into tax-advantaged retirement accounts, where the marvel of compound interest comes into play. Among the popular vehicles for retirement savings are IRAs and 401(k)s. With Roth IRAs, taxes are paid upfront, allowing investments to grow and be withdrawn tax-free during retirement. On the other hand, while traditional IRAs and 401(k)s will incur taxes upon withdrawal in retirement, they still afford the advantage of tax-free growth and the magic of compounded returns. Naturally, there are annual caps on contributions to both IRAs and 401(k)s. Should one reach these limits, Burns suggests looking towards regular brokerage investing accounts, emphasizing the absence of contribution ceilings there. As for the investment avenues, be it stocks, bonds, or ETFs, the choice rests on individual risk appetites. Burns notes that while investments should be relatively aggressive to beat inflation, aggressive has varied meanings, contingent on individual perspectives. Tax-efficient strategies. When charting your financial roadmap, a critical point of introspection should be the financial gap between your desired retirement age and the standard age of 59.5, when most retirement accounts permit penalty-free withdrawals. Identifying this amount allows for strategic allocations into a regular brokerage account, ensuring you have sufficient liquidity if you choose early retirement and aren't yet qualified for retirement account distributions. While withdrawals from these brokerage accounts are taxable, they circumvent early withdrawal penalties associated with certain retirement funds. Furthermore, Burns points out the inevitability of taxes on dividends, interest, and capital gains from investments sold at a profit. She underscores that while taxation signifies profitability, the aim should always be to minimize unnecessary tax burdens. Types of FIRE. Some people mistakenly believe that adhering to the FIRE movement means abstaining from any form of luxury or splurging. However, the reality is that there are multiple variations of the FIRE approach, ranging from the extreme to the more moderate. For instance, there's the lean FIRE approach, favored by those who resonate with minimalist lifestyles. These individuals might save over half their income, aiming to achieve financial freedom at a swifter pace. Woods comments on this, suggesting, for those deeply passionate about freeing themselves from daily work, the lean FIRE approach can be very appealing. On the other hand, fat FIRE resonates with individuals who believe in enjoying the finer things in life. These people set aside a substantial sum, allowing them to maintain an opulent lifestyle in retirement. For example, someone accustomed to a yearly expenditure of $200,000 and wishes to retain that lifestyle post-retirement will undoubtedly need to amass a greater savings than another planning to spend $50,000 annually. Another intriguing approach is the Barista Fire. Those who adopt this strategy aren't necessarily seeking a complete break from work. Instead, they focus on accumulating sufficient funds to retire early but continue with reduced hours or part-time work. This allows them to earn just enough to sustain their preferred lifestyle without relying heavily on their savings. For many, this model provides an opportunity to concentrate on more fulfilling work. Reflecting on this, Woods states, "I envision myself among those who find purpose in their work and see it playing a role in their lives for the long term. However, the goal is to have the freedom to pursue only meaningful roles that align with personal values." With that being said, is FIRE right for you? Please comment below whether this kind of lifestyle is appropriate for you or whether you prefer the more conventional financial path. Thanks for joining me today. Until next time.